Time now for top picks with Rob Lazan. Number one on this day, Intellia Therapeutics, ticker symbol NTLA on the NASDAQ. Rob?
Yeah, so we have a healthcare platform at Middlefield, broad-based, diversified, ETFs, mutual funds, and the one area that looks really exciting is biotech. It's had 2 years of underperformance, and we're starting now to get acquisitions happening where, biotech companies are being taken out for their innovation, right? They're the higher growth, higher risk innovation that a Merck may buy, and then all of a sudden Merck looks like, where did that drug come from, Merck? Well, they bought it 2 years ago. So Intellia is higher risk, and it's not for all of the listeners, but I just wanted to highlight how much I like biotech, and this is one of our portfolio manager that runs healthcare, one of his top ideas. So it's gene editing. So they use CRISPR technology to target mutated genes and try to cure them, whether they're doing it inside your body or pulling out part of your genome and dealing with autoimmune diseases, rare diseases. So they're doing some third stage trials this year that will be a catalyst for the stock if we get positive news. These stocks can be quite volatile, but we really like the technology and the management team behind this company, and it's got $1 billion in cash, so they're not tight for cash, and that's what can hurt some biotechs when they're doing R&D. They don't have the money. They've got enough cash to last them over 2 years by our estimates for doing R&D. So higher risk, higher reward stock, but I just wanted to highlight that we really like biotech right now, and this is one of our favorite stocks in that area.
Okay. Number two on this day, Dream Residential REIT, ticker symbol DRR.UN on the TSX. Right.
Yeah, so Dream Residential is a pretty simple story. They generally have garden-style townhomes, apartments in Cincinnati, Texas, so pretty good demographics in those cities, and a little bit lower rent, so kind of middle-class rents. People are moving to, onshoring is moving a lot of people into Texas, into Cincinnati, so we like that part of it, where they might be able to get some rent increases. They're redeveloping, putting money into these rentals. So the stock's been hit pretty hard recently with, the nervousness on office REITs and real estate has painted a brush on all real estate stocks that have just been out of favor. So I just think it's a real mispriced stock that's trading below its net asset value by over 30%. Its payout ratio is 65-70%, so it can afford its dividend, which is over 6% yield. So I think it's a real good total return story for investors here.
Okay, and number three on this day, we go to the energy sector, which we've talked about a couple of times through the course of the show. Rob's top pick, number three today, Topaz Energy, TPZ on the TSX.
Yeah, this is kind of a all-weather energy stock for your listeners. So someone looking for infrastructure, well, half their portfolio is tilted towards getting royalties and owning the dividends off infrastructure. The other half of their portfolio is earning royalties off some of the best companies and best plays in Canada. So whether it's the Deep Basin, Montney, whether it's the Clearwater, they've got Tourmaline as a client, they've got Tamarack Valley, for example, that we talked about as a client of theirs, just earning royalties. So it's a high free cash flow, high dividend model, a little less risky because they don't have a full team of people working for them drilling. They just own the lands that have the royalties associated with them. So it's kind of an all-weather name that you can get growth. I do think it's mispriced. I think it should be trading around $30, but it's so you get growth and dividends and maybe not as much upside as the pure energy producers. But for a lot of listeners that are looking for something they can put in a drawer and forget about it for a couple of years, put it in their RSP, this name does it for me. And even for the one listener that was looking for an alternative to one of her pipeline stocks. Dividend yield is
6%. The stock has soared since the middle part of February. Is that in line with the rest of the sector on the commodity price rally?
Yeah, the energy stock sector is finally lifting, and I think people just realized they forgot about the stock in 2023, and money's flowing into the sector, and all boats float during that. But I really like this one in the management team.
You expect crude oil prices to continue to rise, and do they need to rise if the sector is going to do well over the next year or so?
Well, they need to, in my opinion, stay above 75 to have longevity in the investor interest, because investors have such a short time attention span right now, where if energy's hot right now in the last couple of weeks because we've had it go from 75 to 85, well, if it goes back to 75, that funds flow, that marginal dollar is going to go back into tech or healthcare or whatever is the hottest new sector. So we do need a little more stability in the energy price, which, you know, we're calling for that $75 to $80 oil to be that price. We're a little bit ahead of it right now, which is fine. But we're okay with it at 75, 80 long term. That gives us lots of opportunity to earn the growing free cash flow out of this sector, and it's just kind of got to be patient with it.
Time for our top pick segment. Stan Wong with us on today's edition of Market Call. You've come with a retail name, and Dollarama is your top pick this time around.
Yeah, we're looking at about $6 billion, just under, in terms of expected 2024 fiscal revenue. It's obviously Canada's largest discount retail operator with 1,400 locations. They have plans to get to 2,000 locations at some point. I just like it because it's a very resilient business model. Not really a lot of competitors around them that have really, done well. Really taking advantage of the fact that there's increasing consumer demand for value-priced goods. We know that taxes are going higher, carbon taxes are moving higher. Things are not easy, so dollar stores tend to be a place that people turn to. A lot of people turn to. So they've really operated really well, very efficiently. They've got great financial performance over the years, very consistent revenue growth, good operating margins. You're not going to find anything for $1 anymore. It's going to be $2 or $5 and so on. They repurchased 13.6 million shares buyback last summer. We've seen a 10% revenue growth rate over the last 5 years. Again, they're going to expand to 2,000 locations. And we see about a 17% earnings per share growth rate on a go-forward basis over the next several years. So really like this growthier type of name. And then when you look at the chart, we're seeing an ascending pattern of higher highs and higher lows.
It has been one of those standout retail stories. Just a real quick follow, because we got a question about another retailer, totally different, in Lululemon earlier.
Sure.
And you said you liked other retail names. I know this is a completely different business, but would this fall into the bucket of other names that you would prefer?
Yeah, other consumer discretion names. So Dollarama would be one of them. Another name off the top of my head is O'Reilly Automotive out of the US, an eclectic name. They sell auto parts. So some of those names that just really don't have a lot of competition and really corner that market, those are the names I really like.
Well, it is amazing when we talk about a market being cornered. Novo Nordisk is your second pick this time round. Now, this is the company that makes Ozempic, and the world has been buzzing about weight loss drugs fueling some of these companies to huge valuations. What is it like about Novo Nordisk at this stage of the game?
It's just a high growth company. $42 billion in forecasted fiscal 2024 revenue. That's going to go higher over the years. It is now Europe's most valuable company by market cap, listed company. They lead the market in diabetes care and obesity treatment drugs. They supply half of the world's insulin. They command 1/3 of the diabetes treatment market. I think around 36 million people around the world use Novo Nordisk drugs. That number is moving higher. We're really seeing unprecedented growth, especially with these weight loss management drugs. It's just a new space. It's a new area of growth. Ozempic's doing well, and Wegovy for weight loss is growing. And then you've got the side benefit of cardiovascular and stroke prevention health benefits from these drugs that Novo Nordisk is finding, which can help drive further demand. The stock has been outpacing the MSCI World Index and the S&P 500 since 2017 or early 2017. So we're seeing a pretty steady but very robust trend in the stock price. The chart is a dream for technicians, and we're seeing about an 18 to 20% earnings per share growth rate going forward.
And can I ask just a final question about the chart? It's funny. Warren Buffett always has that saying about when stocks are selling off, he gets excited. It's like you go to the store and there's a discount, but people don't usually see it that way. Now, when it comes to stocks that are going up, up, and up, it seems like the common sentiment I hear from people is, oh, it's gone up too much. I missed my opportunity. But as someone who has invested in growth for a long time, what have you learned about what happens when stocks have had a nice momentum story, but they continue to have fundamental momentum?
I think you just have to look at the fundamental growth expectations going forward, and a new high today is just for today. A year later, we'll see a new high potentially. So I understand that trying to buy value and so forth, the value really hasn't worked for quite some time. When you look at some of the names that are in the value space, I'm not saying that they won't work at some point, but I think that secular growth is important, and holding names in which there's very little competition and kind of corners the market makes sense.
All right, so we've talked about Dollarama. We've talked about Novo Nordisk. You spend a lot of time getting these picks ready for our audience. We should remind our audience.
Absolutely.
And the final one is definitely a growth story, but one that had a hiccup recently. This is Palo Alto Networks. They are a huge player in cybersecurity. How did this one get onto your list?
Generally speaking, I like the cybersecurity space. I mean, that's not a problem that's going to go away at any point. There's escalating cyber threats. We see them all the time with medium and large size type of companies. Governments have to be careful of that. There's security breaches, and those costs are getting higher and higher. Palo Alto is an $8 billion revenue company, cloud-based subscription services in data centers across the Americas, Europe, and Asia. Medium to large enterprises, service providers, governments, and so forth. Yes, I think what is happening is that there is going to be times in which enterprises and corporations are pulling back in their spending, but that's going to be temporary because you can't ignore cyber threats forever. Certainly companies have budgets and they're going to not spend for the quarter or not spend for a couple of quarters, but they're going to have to come back and address these issues because I think the cost of having to deal with breaches is even higher. And then you're seeing this greater movement into remote work, Internet of Things, everything's getting connected. You need more cybersecurity companies and cybersecurity prevention tools out there. If you look at the shares, they have been trading higher, trading above the 200-day moving average, which is itself going higher, and the 200-week moving average. We're seeing about a 20% earnings per share growth rate with this name. It's one of the largest of its kind in the cybersecurity space. We also own Fortinet, which is a little bit of a smaller company as well, but I do like that cybersecurity space because there are secular growth issues with that area.
Time now for Top Picks. Andrew Moff's still with us talking about some real estate names. The first one today, Andrew, is Dream Industrial, and you started the program by talking about how optimistic you are when it comes to industrial warehouse properties. Does this fit that bill?
Yeah, definitely. This happens to be the cheapest play on industrial warehouse anywhere. Dream Industrial, 2/3 of its portfolio is in Canada, 1/3 is in Europe. They also have an investment in the United States through an open-ended fund of which they're the manager. What I like about their real estate, it's very close to the population. When you have warehouse space, you want to serve people as close as possible as goods go in and out of your warehouse with as much throughput as possible in terms of distribution. There's a big gap, 46% between the in-place rents and market rents, so you can see pretty robust internal growth of 9 to 10% annually, while the stock trades at a big 27% discount to NAV. You have a 5.5% distribution yield while you wait for all that earnings growth. And we think anytime you can buy this quality real estate at a discount, you're going to be in a good spot.
Okay, and staying with the industrial theme, First Industrial Realty Trust is also on your top picks list today.
Yeah, I thought it'd be important to just focus on one name that focused exclusively on the United States, given it's such a strong industrial market. What I like about First Industrial, it really zeroes in on 15 of the best industrial markets in the United States, and it has a heavy concentration in Southern California. And for those that appreciate, the Port of LA is the largest port in North America, where most of the goods flow through the country. That concentration in California has been a bit of a pall on the REIT simply because we've seen a slowdown in market rent growth. Not a slowdown in terms of rents going negative, but just the growth rate has slowed down. They have a big development pipeline, and as a result, that development has been a bit of an overhang as it's waiting to get leased up. I look at it as the money's all been spent. You have the ability to only have upside here and buy the stock at a sizable 15-16% discount to NAV, and you have nice 8 to 9% internal growth in what is probably the cleanest takeout story possible in publicly traded real estate in warehouse.
Okay, 2 industrial names covering the North American landscape. And then your third pick today is more about senior housing. It's Chartwell Retirement Residences. What stands out with this one?
It's demand and supply and a recovery in demand. First of all, on the supply side, we had suffered from too much development of retirement homes going into the pandemic. It's almost non-existent today. On the demand side, we're finally seeing that baby boomer population turn into the prime renters for retirement homes, and that's what Chartwell operates. I think there's about 7.5 million seniors today in Canada. Well, that's going to 11 million over the next decade. And when you have that type of demand growth and fewer and fewer options, Chartwell provides a great opportunity to provide better living accommodations. They have seen their occupancy grow from the pandemic back to an 85% level. Their peak level was 93%, and they're on the road to 95%. So we think you have a great ability to own this trust, trading at a big discount to net asset value. Plus, you have all the upside of over 10% growth in occupancy, which isn't factored into street models at all. So we think they operate quite well, trading at an 18% discount to NAV.
And just a quick follow-on to that, because we got some news today about record population growth for Canada over the last year. As the population ages, obviously the number of new Canadians has been rising. For anyone who's thinking about the housing side of REITs, does that simple story of supply and demand also ring true?
Absolutely. That's been the number one factor between the strength of Canadian apartments and by translation for seniors housing. And what's interesting, when you bifurcate some of that population growth of new immigrants to the country, a large portion are seniors. And they are in that prime renting cohort that will look more and more to retirement living if it makes sense for them. So yeah, that demand has really helped the country overall. And then you have to look at interprovincial migration, which is another demand factor, which makes provinces like Alberta so attractive.
Time now for top picks with Stephen Takasi. Number 1 today, Pet Value, ticker symbol PET on the TSX. Stephen.
Right. We've talked about this one before. It's Canada's largest specialty retailer of pet supplies with almost 800 stores across Canada, mostly franchised. So they have 18% of the market. And industry growth has been, driven by increased pet adoption, 3 million new pets during the pandemic, and higher spending per pet. They generate 22% EBITDA margins, which is really strong, and generate very healthy free cash flow, which has been reinvested in opening 40 to 50 new stores per year, and also building out 3 state-of-the-art distribution centers in Toronto, Vancouver, and Calgary, which should improve margins further. So they've consistently beat consensus since they IPO'd in 2021, but same-store sales growth slowed down since the pandemic boom, and the stock has corrected from $42 to $32, creating a really good buying opportunity. Stock's trading about 19 times earnings now, which is very attractive considering the quality of their earnings and their long-term growth plans to grow the store count to 1,200 stores in the next few years. Okay,
that's Pet Value, number 1. Number 2, MDA, ticker symbol MDA on the TSX, the former McDonnell Detweiler, an aerospace company, correct?
Exactly. So they're actually the only publicly traded pure-play space technology company in the world. And we know they're global leaders in their field. So what's happening is, since the cost of launching satellites has come way down, there's a whole new space economy now that's developed, like satellite-based global wireless and internet, Earth observation, data monitoring and analysis, and space travel, space exploration. It's all booming now, and MDA is really well positioned, capture a good share of that market. They have 3 businesses: geointelligence, robotics, and satellite systems. They have a $3 billion backlog, clear visibility for 20% revenue and EBITDA growth per year over the next few years. They have $17 billion pipeline of potential projects. They're involved with Apple's Global Star constellation and as yet unnamed smartphone provider where they're going to be launching another constellation. And they recently got added to the TSX Composite. It's still a very underfollowed stock, and it's only trading at 9 times EBITDA, which is really cheap considering the massive long-term growth potential of the company.
Okay. And let's go to top pick number 3 on this day, Boralex, ticker symbol BLX on the TSX.
Right. So it's one of Canada's leading renewable energy producers with a strong presence in Quebec, U.S., and France. They have long-term power purchase agreements, mostly in wind and solar. And they have a large pipeline of wind, solar, and storage projects, which is expected to double their production capacity over the next few years. Valuations on renewable energy companies have gotten absolutely crashed over the last few years due to rising rates, cost inflation, increased funding needs, and in some cases dividend cuts, as we saw with Algonquin earlier on. But Boralex is like by far the best company in the sector, which should see a rebound as interest rates come down, by the way. But they have very high quality assets, best management team in the business, robust pipeline of projects, and multi-decade growth and tailwinds. So under $30, it's just a great entry point into this stock, and it's trading at historically low multiples of around 9 times EBITDA. So they just announced record results. 22% growth in EBITDA, strong free cash flow generation. It's a great time to get in.
Why do you call it the by far the best stock, best company in the sector?
Well, look, Intergex had to cut their dividend, and they've been serial equity issuers. Northland Power CEO just stepped down. Again, they got in over their heads on some big projects. I mean, they are experts at offshore wind. And Algonquin, well, we talked about that earlier on. And so, Boralex really stands out among the crowd.